Hey, welcome to The Explainer. This is where we take big, complex ideas and break them down with some simple, powerful slides.
And you know what? A lot of people would say yes. It feels like the smart, safe thing to do, right? You're just taking your chips off the table. But what if that's wrong? Today, we're going to dig into that and really challenge that whole idea. We're going to unpack why the safest move might not be safe at all.
Whoa, okay, holding a lot of cash is a very dangerous thing. I mean, that probably goes against everything you've ever heard, right? It sounds totally backward. But stick with me because diving into this just might be the single most important financial lesson you learn this year. All right, I can already hear you thinking, but hang on, what about Warren Buffett? I see headlines all the time saying he's sitting on a record pile of cash. And look, that's a totally fair question. But the thing is, those headlines, they're only telling you half the story. Let's actually look at the numbers. Even when he's holding what they call record cash, it's still only around 30% of his entire portfolio. The other 70%, the huge majority, is still invested. So what you've got to realize is this is a move of relative caution. It's not him pulling everything out and running for the hills. And this is where the real trap is for most people. You see that headline about Buffett, you panic, sell everything, and then you just wait. But the danger isn't just, being invested when the market dips. The real risk is something way more permanent. It's a mistake that honestly, a lot of people just never bounce back from.
So to really get this, we need to look at the two big risks you face when you're dealing with good long-term assets. Think of them as two different kinds of financial pain. But the key is, one of them is temporary, and the other one can be permanent.
Being stuck, that's when you buy something and, the price drops. It feels terrible, right? We've all been there. But here's the thing. If it's a good quality asset, that's usually a temporary problem. Now, missing out, that's a whole different story. That's when you sell, or maybe you never even bought in, and then you have to just sit and watch as it goes to the moon. That is a permanent problem.
And here's why that's so true. I mean, just look at history. Think about Amazon after the dot-com crash, or Bitcoin through all its crazy cycles. These things can have absolutely epic, terrifying drops. We're talking 80, even 90% down. But then what happens? Over time, they not only recover, they hit incredible new highs. If you're still in the game, you come back. But if you cashed out, you missed the entire thing.
And this quote just nails the psychology of it. It's so easy to say, I'll just buy it back in later when it's lower. But actually doing it, that's another beast entirely. Imagine you sold Bitcoin at a few $100. Now you're staring at it at $100,000. The mental gymnastics it takes to buy back in at that price, for most people, it's just impossible. Which brings us to another huge point. Wealth is all relative. It doesn't exist in a bubble. If everyone else's assets, stocks, houses, you name it, are all going up in value, and you're just sitting on a pile of cash, you're actually getting poorer. Your slice of the pie is shrinking. Standing still, financially, is pretty much the same as going backward. Okay, so this next part, this is the real mind bender of this whole explainer. We have to completely change the way we think about what holding cash even means. This is so important. Holding cash is not a neutral position. You're not on the sidelines. It is an active, aggressive financial bet. Think about it. By holding cash, you are making a bet that every other asset, stocks, real estate, everything, is going to go down. You are literally shorting the entire market. It's not safe. It's a huge bet. Yeah, because there's no timeout in the game of finance. There's no pause button. Your money is always in some asset pool. When you sell a stock and go to cash, you didn't leave the game. You just traded one asset, the stock, for a different asset, cash. So every move, even the move to do nothing, is an active choice. Okay, so if just hoarding piles of cash is this huge, dangerous bet, what's the alternative? Let's talk about a smarter way to do this, a system, instead of just a guess.
Now, the goal here isn't to have literally zero cash. The key is to know the difference between idle cash, the stuff just sitting in a safe, losing value to inflation, and yield-bearing cash assets. We're talking about things that are still safe and liquid, but they're actually working for you, earning you an income. We're not talking about a little bit of interest. We're talking about potentially hundreds of times more than a regular bank account. So here's what a system could look like. It's actually pretty simple. You just decide on a range for your cash-like assets. Maybe if you're cautious, you say, I always want to be between 50 and 70% cash. And then you only make a move when you fall outside of that range. That's it.
It takes all the emotion and the guesswork out of the picture. And this quote from the investor, Dujan Yongping, it's just brilliant. Someone asked him if he regretted not selling a stock when it hit its absolute peak, and his answer gets to the heart of the system. He said he doesn't sell to take profits. He only sells when he finds a better investment to move his money into. See the difference? It's about looking forward, not looking back.
All right, let's wrap this up. How do we put all this together into a simple plan you can actually use?
It really comes down to these 3 steps. First, set your bands. Decide on your percentage for cash-like assets and just stick to it. Second, only make a move when you find something better. Don't sell just to sell. And third, focus on boosting your cash flow from your job, from your assets, from everywhere, because that's the fuel for this whole engine.
And when you get right down to it, that's the whole point. This isn't about trying to guess the future or time the market perfectly, because nobody can. It's about building a system, a logical machine for your finances that runs on rules, not on fear or greed. So that's the real question I want to leave you with. When you look at your own finances, do you have a system or are you just making a guess? Because the answer to that question, well, it could make all the difference in the world.